All right, good morning, everybody. And happy Thursday. Looks like we've got the technological gremlins figured out. So that all right, good news. Good morning, everybody. And
let me just quickly get the audio
happy
properly
Thursday.
hooked up.
Looks like we've got the technological. We should be good. Gremlins figured out. So that all right. Good news. Good morning, everybody. And
Let me just quickly.
all right, now you should hopefully hear me really well.
Thursday.
Looks like we've
Good.
got the
All right.
technological.
Perfect.
Good.
Can you guys hear me okay? Does this sound good? And again, apologies for yesterday's technological problems. Basically, what happened yesterday is the screen sharing function didn't work, and it was just what happened is we had a
Good. All right.
we had a the software wasn't updated, and
Can you guys hear me okay?
as it
Does
is
this
with
sound good?
software, sometimes they have
and again, apologies
it has
for
mind of
yesterday's
its own
technological
and
problems.
basically what happened yesterday, and then it just
is,
didn't work. But we're good now.
screen sharing
So
function
didn't work, and it was
very
just
good. So
what
if you
happened
guys
is
can
we
hear me,
had
just give me a
a-
quick.
Yes,
All right.
we had
into
the
chat
software
box,
wasn't
if you don't mind,
updated,
I
and
just
want
wanna
to
make
make sure
Can you guys hear
we're
me
good.
okay?
As it
Does
is
this
with
sound good?
software,
There's an echo.
sometimes they have,
And again, apologies.
all right,
for
that's not
yesterday's
good.
Technological
And
problems.
the echo.
Basically, what happened
See if I can
yesterday,
figure that
and
out.
then it just
Is,
didn't work.
But
Echo.
we're good
Screen
now.
sharing
So
function
didn't work.
Oh,
very
very good. So if you guys can hear me, just give me a quick.
All right, how is this now? No more echo? Let me know when the echo is gone. I'm just going to keep yapping. But I think it should be gone now. Video is good, and the echo is still twice, or is it better now? Better? All right, good. Excellent. Good, good, good. All right, here we are. That's what you get, right, for trying to run these live streams. Anyway, we're ready to get started. So good morning, everybody, and happy Thursday. We have the second day of our 3-day boot camp starting in about 25 minutes. So make sure you join us there if you signed up for that. We're going to start going through our higher inflation for longer portfolio, the details of that mock portfolio. We're going to look at the higher inflation for longer themes as well. But here, of course, we're going to go through today's sort of more imminent things as well right now in the next 10 minutes or so. So basically what we had yesterday is a consolidation day. Today, of course, U.S. markets are closed. The equity market, U.S. equity futures are going to stop trading in about 25 minutes from now. And the bond market's going to close. Cash bonds are going to start closing, or going to close at, I believe, 2 Eastern. So what I'd like to bring across here this morning is that the bond market is now definitely in the driving seat for equities. That's not something that has really mattered that much over the past number of years. 2022 maybe to some extent, but I think now the bond market's in the driving seat. So I want to walk you through that and what that means from an allocation perspective and from a trading perspective as well. Quickly though, I do want to show you this chart because I was talking about it yesterday, but I couldn't share it because of the technological gremlins we had to deal with yesterday. But we had on Tuesday, we had what's called an outside bearish reversal day in NVIDIA. And I just wanted to bring it up here as well, just so everyone has seen it. And essentially what an outside bearish reversal day is just a day when the market goes up, it closes at, typically opens up higher and then closes at the sort of near the lows of the day. And so basically we have a lot of resistance now for NVIDIA around 150, 153. That doesn't mean the stock has to fall apart. It just means that there's probably resistance up there. So there's at least a consolidation phase. And so what we know when we look at previous outside reversal days is that they typically lead to some sort of a pullback. I have all these arrows here, and these are all the outside reversal days that NVIDIA's had going back to March of last year, so 10 months or so. And basically what we're seeing is that every time we had an outside reversal day, it did mark the top for a while. It didn't mean the collapse of the stock, and that's certainly not the call here, but it did mean that there's some sort of a reversal or pause in the stock. I mean, just for an FYI, last year when we had those reversal days in the summer, ultimately the stock dropped as much as 34%, and then a bit less than that in August, and so these things are important to see. Before we get to the bond market, let's also quickly talk levels in the S&P. This is also something that I've been making sure that everyone has a sort of a solid handle on. The SPY ETF is the tracker for the S&P 500, of course, and I still think that the lows on December 20th are probably important lows to watch. So basically, what it means is that we have a support level there around 580, and if the 580 level were to break, that would probably be sort of the lead to a bigger drawdown. I mean, and that's not to state the obvious in terms of the chart. It's just the December lows, the December 20th lows came basically right after the Fed meeting, where we had a 3% down day on the 18th of December, I believe, and then the market basically continued down for another day and a little bit, and then rebounded. So those December 20th lows are important. I would think from a risk management perspective, certainly for us, if we were to break those lows, I really think we can make it a full 10%, and then the S&P could probably head sort of towards 550 or so, not in a straight shot, but just kind of directionally speaking. So we'll watch this. There's just a lot happening here. As I always say, January is choppy. It's where the market tries to find some sort of a rhythm, and this January, obviously we have a new administration coming in the White House, and so it's going to be probably amplified, would be my guess. But also, I think that's going to speak to a lot of trading opportunities, particularly if we use momentum. So let's take a step back, and from the very near term. So that's number one is Nvidia. So I just want to make sure everyone's seen that. S&P levels. But let's talk bond market and inflation. So we've been talking about this higher inflation for longer theme now since last April. Shockingly to me, a lot of people still couldn't care less about it. They will, and they're probably going to underperform badly over the next number of years, is my guess. So I want to make sure everyone knows that portfolio allocations probably have to be different than they were for the past 5 to 10 years. Most people don't care until their portfolios are down 30%, and that's, of course, then it's too late. So I would encourage you to be a bit more of a planner than most people. But I want to show you this chart first, because this, I think, kicks off into the right direction. What we're looking at here is ISM services prices paid. This is a data point that comes out on a monthly basis, and basically what it does is it leads PCE. And you might say, Serge, this is boring, I don't care. I just want to apply a call option on something. The call option buying is not going to work in an environment as easily, I should say, in an environment where the bond market is essentially in charge of what the stock market might do. So the bond market has been selling off, and this is just the latest confirmation from our perspective that inflation is going back up. I think it's obvious if you look at most things are picking back up in inflation terms. Milk, for example, just one little tiny thing. It's actually a big thing, but you know what I mean. But what's important is ISM services paid. That data point came out a few days ago, and it actually leads PCE. Why is that important? Because PCE is what the Fed likes to use for their inflation gauge. So here you're looking at a data point, the blue line, that's actually leading what the Fed likes to look at. Now, obviously, the Fed knows this; they're not stupid, but it's important for people not to ignore these reinflationary forces that we see happening. And so when it gets to the bond market, I just want to bring this point across. We'll just look at 10-year yields here for a minute to keep it real simple. The reason why this matters to the stock market is for a lot of reasons, but if 10-year yields are breaking towards 5%, what's going to start to happen is more and more people are going to start to look at the bond market as an alternative to at least some of their stock holdings. And that has a, self-reinforcing sort of, it's like a feedback loop, and it feeds on itself. So it basically means less demand for the equity market, but also as you have a higher interest rate, what ends up happening is that the discount rate that has to be applied to future cash flows, and that's particularly vulnerable here would be the technology sector, which everyone is long 10 times, can underperform because of that. So you have to discount the future cash flows to a lower net present value, meaning a lower current stock price. So I would encourage everyone to kind of look at these dynamics. And as we're going to talk about in our bootcamp day 2 here in just starting in about 15 minutes, we're going to go to this in great detail about what that means in terms of a not only where do we want to focus on from a trading perspective, which I know a lot of you guys are still focusing on the trading part, myself including. It's going to be a trading year this year. But also, where do we want to allocate like the majority of our money, or how do we want to diversify our portfolio, which is going to become more and more important, because diversification is going to become a thing again. Trust, at least according to our analysis. Let me see here. Those are the things. Oh, and then I also want to go through. I'm trying to show you some of the charts that I couldn't show you yesterday because of the silly software problem. Oh, okay. So tomorrow we have payrolls. Obviously today equity markets are closed as a day of mourning for President Carter. But tomorrow the equity market's going to go open back up. And of course tomorrow morning we have the jobs report. So what does that mean? Well, when we look at our momentum work, for example, the S&P 500 right now is still very much in a bullish trend, right? So the longer term trend remains higher. However, it's in a very choppy, what we call the chop zone from a momentum perspective. So as far as I'm concerned, the odds of the S&P breaking below 580, maybe even Friday, or going right back above, let's say 600, which is sort of the mini range that we have, are about equal. So I would be much prefer to be reactionary here than anticipatory, meaning I would much prefer to wait until we have a reaction from the market on Friday morning. And we're going to live trade this in the boot camp as well in day 3. So day 3 is tomorrow. So if you guys want to live trade the post and non-farm payrolls with us on Friday, you can do that in the boot camp as well with us. But I think this is the range for the S&P for the near term. So you've got about 580 and about 600. And I want to see how the market reacts post non-farm and then do a trade as opposed to try to anticipate. Because again, remember there's 2 things that we look at the way we measure the market. One, what's the trend? The trend remains bullish for the S&P 500. So I can show you that on the market rover real quick over here. Let me bring that over. If I could find the thing here. All right, let me bring that over. But from a momentum perspective, so we like to use our momentum indicators for momentum, which is the more near term. We are in a choppy period. So you can see, again, the trend very clearly bullish. That's the green background color. Market rover doing exactly what it needs to do. That's the primary factor. And the secondary factor, or the more near-term factor, is momentum. And so, when we look at the S&P 500 in the near term, again, we have, in the interest of time, I'm not going to show you the indicator right now, but we're in a choppy environment when, again, what we call a chop zone. And the chop zone is it tends to lead to a lot of paper cuts in terms of from a trading perspective, because there's not really a clear direction. And by the way, just as an FYI for the S&P, like the S&P is literally exactly at the same level as of yesterday's close as it was on this November 6th when we broke higher past the election. So in many ways, in every way, the S&P has done absolutely nothing. So this is November 6th, and this is where we closed yesterday. So the S&P has done nothing. It's gyrated a little bit and generated a lot of commission for brokers, but in the aggregate, nothing's really happened. So we need some sort of resolution. My hunch is we're going to go lower before we go maybe higher again, but it's going to be a trading year. So I'm more focused on the trading opportunities here than. But again, the year is also just getting started. So I think we're going to get a lot of headlines. I think everyone's anticipating that. But the bond market is going to be what's going to give us the confirmation for the broader risk on or risk off moments here for the equity market. So that's it, guys. That's all I have today. Obviously, U.S. markets are closed today. We're going to see you guys over. For those of you guys that are part of the boot camp, we'll see you over there in just about a little more than 10 minutes. I look forward to seeing you guys there tomorrow. No set the market because we do this Monday through Thursday. But please make sure you subscribe to the channel and that you give us a thumbs up like. That way you get alerted through the YouTube website in real time when we go live. Thanks for being here. Glad we got the technological gremlins out of the way. And we'll see you guys over in the boot camp if you signed up in about 10 minutes. See you soon.